one of the specific reasons is how strong the rental market's been at the beginning of this year. This has been the best rental market that I have experienced in my 11 or so years in doing this. So really significant rent growth, and then all the macroeconomic trends that lend well to buying real estate.
I'm Drew Brenneman, and this is the Rise and Invest podcast. I bought my first 2 properties as a 19-year-old with my own money that I earned from an online business I started in high school. I've now grown my portfolio from that first duplex to hundreds of millions of dollars of investment property. My goal with this show is to give you the resource I wanted when I first started out. Subscribe to our podcast where I break down real-life stories, tactics, strategies, and current market information you need to be a successful investor. All right, welcome back to the Rise and Invest podcast. Here today with Joe Smazal, top multifamily investment sales broker in Chicago.
Thanks for having me back, man.
Yeah, I know Joe. He's guest number 1, so he did a great job, obviously, since he's back.
Well, that was both of our first podcasts, so we've got nothing to blame it on today, I guess, if it doesn't go well. But good to be back, man. Thanks.
Yeah, no, definitely. And I think today, probably 6 months or so since we recorded that, so want to do like a Chicago market update. Actually, a lot's happened in Chicago, and then I had like a bunch of brokerage related questions I was going to ask you, and then we already filled up like 90 minutes, so we had to cut it. So
all right,
we'll do those.
When I ramble, stop me then.
Yeah, well, we no, I think people like the the long form sort of answers here. And 2, I think before we get started, maybe with the questions, I just want to mention our website where we mentioned this in the outro of the podcast, but haven't really mentioned it much at the beginning. We have a ton of written resources on our website. We have our portfolio, so every deal we've done listed on there with 2 or 3 paragraphs about it. So essentially like a brief case study. We have a blog. We wrote a trends report for real estate trends. This is probably we're going to need to add a whole interest rate section to the to the trends report now. That's the number 1 topic today. Also on there, probably most importantly, we have a 100+ page passive investing guidebook. Really the goal of that is, could teach someone who doesn't know really anything about real estate yet, kind of what the terms mean, what to look for in the sponsor. Really covers a lot. Obviously, if it's 100+ pages, it's like 101 pages. So we just got to the 100. But into like a lot of the jargon we would use here on the podcast, like if we don't explain it, that would be in the guidebook. There's a glossary, so that would be where to go. Our website is riseinvest.com, and then 2, you can sign up to be an investor in our deals there on the website. There's a orange button in the upper right. Can't miss it really. It says invest now. You just put in a little bit of information, just basically your name, address, email, I think, and then you're on our list from there. And there's not always a deal available, so you're really just signing up to be on the list when deals come out. And then obviously happy to chat with anybody who wants. Best place to get started though is through that investor sign up link. Cool. So now that's
good stuff, man.
Yeah,
that's awesome.
That's out of the way. So I guess just kind of maybe on you. I know let's just for a quick intro from Iowa, then here in Chicago, got into multifamily brokerage.
Yep.
About 500 million total sold. That was 6 months ago.
Yeah,
so now we're
for 6
probably
months of this year. Knock on wood. Today we've got a good sized deal closing, but should be about 100 million sold in the first 6 months of this year. So update the bio on
I feel like it sounds
Instagram page or whatever.
I feel like it sounds better when it's more of a round number though. Where if it's 500 plus, where if you update it to 602 million, like then it's like it's like too exact,
like a running ticker.
Yeah. But nice. Yeah. That I know I was thinking about that when I was putting some notes down. I was like, it's going to be almost, it's probably, I'm sure it still feels hard, but it's almost would be hard to not be selling 100 million a year with kind of the momentum you got.
Yeah. I mean, maybe we start there.
Yeah.
The beginning maybe we should start by putting kind of a timestamp in case we're in a pretty dynamic market. So in case things change, but we're in early June, 2022. The beginning of 2022 in the Chicago multifamily market has been really healthy, really strong. and also very balanced. You know, I feel like there's been a lot of compelling reasons to buy real estate generally, and then also specifically in Chicago. One of the specific reasons is how strong the rental market's been at the beginning of this year. This has been the best rental market that I have experienced in my 11 or so years in doing this. So really significant rent growth, and then all the macroeconomic trends that lend well to buying real estate. It's also been a good time to sell too. So it's ended up being quite balanced from a buyer and seller standpoint. You know, I think in the residential world, a lot of people classify a market as a buyer's market or a seller's market. I think it's a little bit too nuanced in what I do to say that generally, but anyway, it's been a healthy market for parties on both sides of the table. So it's ended up translating into a lot of people trading, you know, selling something that's a little bit of an outlier for them, and exchanging it into something that's more, you know, they've either got a fresh business plan for, or it's more in their geographic focus, or it's a little bit bigger, you know, whatever the rationale is for doing it. Really strong start to the year for those reasons. The market is still quite healthy and robust. I mean, there's a lot of activity, but I would say, in my experience, again in Chicago, the top end of the market maybe the lower end of the market have been a little bit softer, a little bit slower. Hasn't really translated to change in pricing yet. If it stays slower, I think it will. But
And you mean top end for?
So on something that's, I'm sorry to cut you off, but I think I know where you're going with the question. So if something is, say, new construction or recently rehabbed, and the rent roll is basically today's rents without it really anywhere to push it, you know, that's been a little bit tougher because that market is very impacted by the cost of borrowing, you know, and there's nothing to really do to those type of properties to offset a higher interest rate. So the spread just gets tighter, and we might still be able to sell it for the same price because of buyer timing and circumstances, or because of the desirability of the real estate. But I would say, generally speaking, a little bit slower. And then, you know, the product maybe in tougher areas of the city where, you know, people were buying with like agency, small balance loans, and max leverage, low interest rates, non-recourse, buying purely on kind of today's cash flow. You know, those deals are obviously also really directly impacted by your cost of borrowing. The middle of the market, good size building, good location, palatable price per unit, that stuff has been unimpacted, is as strong as ever.
Okay, nice.
Yeah.
And yeah, what have you then for rent growth then? What have you been seeing, would you say?
I'll start by saying I think the average that I'm seeing, it depends on the submarket, but I'm saying the average is probably 7 to 8% rent growth year over year.
Yeah, over last year.
Yeah, okay. Over last year. And last year was probably a normal. So if you go 2019 to 2020, we saw rents go down. 2020 to 2021, rental market kind of stabilized to where it was in 2019. Again, speaking generally, there are nuances to this in the submarket and the product type. So this I would call just straight over a, you know, seasoned regular rental market, healthy 7 to 8% net effective rents. Concessions basically fully burned off. There are markets where it's a lot higher than that. I think the markets where it's higher, you're working off kind of a depressed 2021 rent roll still. Maybe a market like new construction stuff in Logan Square. I think if you look year over year, 2022 to 2021, the rent growth would look crazy, but it was hit a little bit harder. And then there are markets that are just more sensitive to rent growth. So I'd say, you know, there's probably markets where you see 4 or 5% still.
Yeah.
Yeah.
Yeah. It's interesting. I would say on the Chicago stuff I have, which is still pretty big sample size, like let's call it 2016 to 2020. I didn't really see much rent growth. You know, I had the bigger units, you know, 2 bed, 2 baths, 3 bed, 2 bath kind of units.
Yeah.
Didn't really see much rent growth there. The deals did fine because we bought it knowing the rents should be higher, but then we sort of got it to that higher rent, and then the market didn't really move much on those. Then 2020, then they dropped. 2021, I don't feel like we got back to the 2019 rents yet. But then this year, I remember starting the year, we're making our sort of renewal numbers and then what we would put it on the market for. And I was thinking, okay, let's try for 3% maybe on a renewal, and try to get back to the old like highest rent. We actually ran a calc where every unit, going back when we had the info, what was the highest rent we ever got, and then let's try for that rent this year.
Okay, so you use like the high water mark from that immediate sample size of rent roll.
Yeah.
Yeah.
Where actually by on that exact unit.
Okay.
Type, let's say if there were 8 of the same unit, we would see what was the highest rent ever paid on those 8.
Got it.
So that's what we were going to go out with this year, and we just blew through that though.
Oh yeah.
Yeah. So we were thinking, okay, we're going to be talking about inflation and try to, for once, get these get a pretty big renewals. Where normally I'd say our renewal strategy is try to not have a lot of churn.
Yeah.
Keep your turnover costs low. Our buildings, we don't have any people on site, so then leasing, we're hiring that out. Then that's a big cost if you're going to hire out leasing on a turn, because then it gets beyond like probably normally I think people would assume like a apartment turnover cost like a month, let's say, between a couple weeks of downtime, paint and clean could be a month. But here it's in Chicago, it's more if you have a broker, because a lot of times a broker is looking for a 1 month commission.
Yeah.
So then we started out going for these max rents. So like for a real example, like our Wicker Park 2-bed or 3-bed 2-bath condo quality units, I have 30, 20, I think 40 of those. So like between the Pierce 1449 Wicker Park and the Evergreen deal, like 40 of the real similar units. And the highest, I think or were you going to say something?
I was going to say it's a big percentage of the rental stock for that. I mean, that's a low density submarket.
Yeah.
And there's not a lot of newer construction stuff of that size. So 40 units is not, people look at it and say it's not a huge sample size, but in the context of Wicker Park, large units, condo quality, that's a lot of what's out there.
Yeah. For that profile deal, I feel like in that like pocket, I think I bought all the deals.
Yeah. I don't know.
Where the basic's been 3 for sale in the last 10 years, and I bought them all.
Yeah.
But yeah, that is, and the reason that happened, we were crushing it with those where they were renting for like $2,600, and the rent should have been $3,000 at the time. So we raised it, and then the market grew to $3,300 on those. And then a couple units we beat that. We got $3,400 a couple times, $3,500 once. So then this year on that unit where we basically leveled off at $3,300, we're getting $3,650 now. So
yeah.
All of a sudden, like, hey, and that's a lot of reasons for that. People coming back out into the rental market that were sort of, wherever hiding or doubling up, not, and also these are bigger units. So if you're looking, our like potential renter pool opened up a lot. Where now, if you're going to still need to work from home, maybe that extra bedroom or 2 extra bedrooms as an office, that's what you wanted. Where before you wouldn't pay for that. Now you need it if you're going to be working there.
Yeah, it's a pretty sticky product type because people are going to settle into that unit. They're going to use it as an office or put their Peloton in there or whatever. And you're not jumping around to another 3-bed 2-bath because, like we just talked about, there aren't that many of them out there. So somebody might buy a house, somebody might move out of state for a job transfer, whatever. Get married, have kids, whatever the reasons are that are healthy. But it's generally not like a musical chairs type rental market for that type of stuff.
Yeah, there's usually a reason, but real commonly our renters were just like 3 roommates, so each person taking a room, and then that was not as sticky of a renter, but we're seeing a much more sticky one, like you were saying, where it's people who are gonna be there. What would you say then, just kind of like generically, our cap rates today in the areas you're covering? And actually, I'll define a cap rate. So we actually
this is for Mr. Brenneman.
Yeah, so shout out to Doug Brenneman. I think my dad, he watched one of the podcasts. I think it may be his first one recently, and we were kept throwing.
Did you watch ours first of all?
I don't know. He watched the one on the 96 unit that we bought, and he said that like really a lot goes into these things, where you can see why you have the staff and like what's all involved. Anyway, so cap rate, really what that is then. So I took the definition out of our passive investing guidebook and just that's what's up on my screen here. So the cap rate, that's the yield a prospective buyer expects a property to generate in terms of its net operating income relative to the purchase price. This metric is depicted as a percentage. A higher cap rate is usually indicative of a riskier property. The investor requires a greater yield and thus willing to pay less for the property, while a lower cap rate represents a less risky property or potentially more growth in the future because they'll pay a bigger number for that. So just like as an example, if the net operating income was $100,000 and you paid $2 million for the property, 100,000 divided by 2 million is 5%. So then if I'm talking to Joe, I'd say I bought a 5 cap or a 5.0 cap. Also, some people, they think of this as like the yield you would have if you bought a property all cash.
Yeah.
So if you did that in that example, and you have no loan, you paid 2 million for it, and you make 100,000 a year of income off of it, that's a 5% return.
Yeah.
So that's what we're talking about. So then the importance is, as the cap rates go down, that means the properties are appreciating in value. But also, if you were to buy one today, at least in the day one return would be lower. Whereas if cap rates go up, that would mean that the prices were moving down, and then you would be making more day one. So anyways, now with that out of the way.
So we're at cap rates in Chicago.
Yeah. Where would you say they are?
I'm going to preface my cap rate answer with, I think it's tough to talk cap rates in apartments. I mean, we do. And you have to make apples to apples before you do, so a lot of it will vary from who's underwriting the deal and if there's upside in the deal versus if it's fully stabilized. So I'd say assuming a property is underwritten consistently with the rest of the marketplace, we've seen cap rates in Chicago in the 5 range, from about 5. Some deals compress lower to 5 if it's prime submarket, large property. There's scarcity in inventory, then it'll end up compressing the cap rates down in the 4 range. Probably nothing lower than 4 unless it's a deal that's egregiously mismanaged or super low rents or a total value add deal where somebody's going to renovate it, in which case the cap rate's kind of moot. To maybe around 6, and then if you're in kind of a fringier, tougher submarket, they go higher than that pretty significantly. I don't do as much business in those submarkets, so I'm probably not the guy to opine with like much substance on those. But in the markets that I work, which are generally kind of the north side of the city, and then in and around Hyde Park, they're in the 5 range, depending on the asset. So,
and this is a stabilized cap rate, so call it like a 5.0 to 5.5. Would you say, or
some stuff in the higher 5s, maybe if it's got a commercial component to it or something like that, in which case we'll usually look at a blended cap rate because the market for street level retail was softer over the course of the last couple of years. There's more risk in it. Generally, somebody expect a higher return for that type of deal unless it's a Starbucks or Foxtrot or something really cool.
And then how do you, I guess, too, one thing to mention with the whole cap rate talking, that's the first thing you had said, was really you have to, as a buyer, understand how the other buyers would underwrite something.
Yeah.
Where maybe you can run a deal cheaper than the next person once you have it, but really that shouldn't factor in how you value it.
Right.
So when you're talking about consistently underwriting it, really what you would want to do is figure out how's the market assuming property taxes should be underwritten. Utilities and insurance, typically those you're just kind of known for the building, but that meaning that you can get a financial statement from the seller and get that info. But then the other stuff like repairs, turnover, leasing, management fee, replacement reserves, taxes, you need to figure out what the other people are doing.
Yeah, I mean, I think most of the deals that we underwrite have between 30 to 45% expense load of effective gross income. So that's income less a vacancy factor. And half of that or so is very operator specific. Utilities, taxes, insurance, those things are fairly fixed. You can improve them, but within a pretty tight margin. Things like staffing, leasing, how you handle repairs, how you handle turnover, those are really operator dependent. So I think it's great advice to have your model and understand how you operate, but then understand how the market underwrites too, so that when you're looking at deals, you can do a really quick look and understand whether it fits within the realm of reality based on market underwriting. And then if it does, you dig in, you say, oh, I think I can do this better. I think I'm going to run this heavier. Well, so it's funny to me when somebody, I shouldn't say it's funny. I like getting feedback on my underwriting versus prospective buyers because that's constructive. And I need to stay very in tune with that because I need to make sure that mine is realistic and is, I guess, saleable into the marketplace. I want to present deals in, I'd say, the best light possible, but within a degree of being realistic. I want people to see it, and it's going to be underwritten similarly to how most people will or how the lender will. Anyway, when somebody gives me feedback, I like to hear that. But, if somebody says, you're wrong, staffing this property is going to cost this. It's like, okay, to you. Yes. I mean, I'm not a smart ass about it, but it's like, but to each their own, and then the next person comes and says, I don't need any additional staffing for this deal. I own the building next door.
Right.
I run these together, and I don't underwrite assuming that the buyer owns the building next door. But I try
somewhere
to
in between,
right. That's right.
You don't want to be the one presenting the highest expenses, where then buyers are going, oh, maybe I should be doing more for payroll and repairs.
This? Yeah. So it's about being within kind of the middle of the curve, I'd say. And I understand, if there are any buyers listening, I understand that you're going to flex based on your operation. But I can sell a 2 cap if somebody can turn it into a 6 cap. Right. So like sometimes these cap rates get quoted, and I think on some of the deals that you bought in Phoenix, you look at a really compressed cap rate, and somebody's like, how are you making sense of a 3 cap, Drew?
Yeah.
What are you doing, man? Like, the interest rate is 4 now. How are you doing? But
right.
You have a business plan.
Right.
You understand the submarket. You understand rent growth. I mean, there's a lot more to it than the quoted cap rate. So that's my cap rate right. Soapbox rant.
Because the people that are doing this all day, really what they're looking at is this is some jargon here, so I'll define it, but really like a day one untrended market cap rate, meaning if I could just snap my fingers and reset all the rents and expenses at the building to what they should be based on what I'm seeing. And untrended means with no growth. So obviously you can't snap your fingers and change the rents. People have leases and there's contracts in place at buildings. But if you could, like that's actually how I would generally look at the deal. And right, in Phoenix, often with how much rent growth they've had, so 2 years in a row of 20+% rent growth, we bought deals where the owners, they didn't really do much during that time. Maybe they have now a 2-bed unit renting for like $1,100. We go there and go, this should rent for $1,450, and if we add laundry and clean it up, we can get $1,650, $1,700.
Yeah.
So right, what's our cap rate on that? The day one going in, it might be a 2.9 or a 3 or something, but the untrended day one, if you could snap your fingers, have the renovation done, it's a 5 something. So then the whole thesis is we can kind of get that to like a Chicago or Midwest cap rate for all the work we're doing, and then our payoff is we have the growth and they're real favorable in Phoenix with the property tax treatment and Maricopa County and I think all Arizona. But that's sort of the same point. So then you could see a headline where someone in Chicago pays a 3 cap and you're like, what are they doing? But it's like, well, they're going to renovate it and then it'll be a 6.5 cap and then they're going to sell it for a 5.5, and that's how you make money.
Yeah, and we're not selling net lease deals. We're selling. I cannot think of an example in the last several years where somebody bought a property based on a cap rate, in air quotes. I'm not going to do the air quotes, but a cap rate today. People buy these generally for a longer time horizon than that. Even if it's to execute a business plan in 3 years and exit or refinance, it's not 1 year. The marketplace just doesn't allow for that generally.
Right.
So, the cap rate today is an indication. It's a snapshot. It's a way to look at deals quickly, but it's not the end all be all metric to the extent that I believe it's discussed.
Yeah, no, you're right. And that's why the people who like on the, let's say back end, like down the chain, like if I'm talking to like a single investor who knows all the real estate jargon and has a bunch of deals like that, we'll talk about, it's more like what's your, like untrended, if you could reset the whole thing, cap rate, what's your going to be all in basis.
Right.
That's, that makes sense. But again, you need to know how people are underwriting deals and where cap rates are today. Cause then even if you could, in that made up example, I was saying the deal you bought at a 4 cap and raised the income, now it's a 6.5 cap. You need to know what's going on when you go sell it, because you're not going to sell it for a 4 cap anymore. That worked for you because you had this whole business plan to raise the income a lot. So you need to be talking to brokers and folks and know what's going on. So
Yeah, and it's it's easy to do. These are not super complex models generally to arrive at a cap rate. I mean, if you're
right,
looking at an IRR or something, it's a little bit more of like you're running an Argus, you're running a 10-year horizon. Like for just a quick look, you have your
right,
model and you understand the market's model, and then you see how the things compare, and then you make nuances and adjustments. Yeah.
yeah, you're right. And then even like on the pro formas, like really we would have like at least for Chicago, I'd say some of the like we would have like two different pro formas basically, almost like here's how people value it and here's how we think it will run, because there'll be a little bit of nuance. Like
Yeah.
you're maybe increasing your taxes to value it, but they don't increase immediately. Whatever increase you're baking in, so you might have a year or two or three, or I mean, there's deals where we've had them for a long time. We're still waiting for that increase, and we just got lucky and missed a couple times on these every 3-year reassessments.
Yeah, and the reality is there's when you're running a forecast or a pro forma, there's stuff that's out of your control.
Right.
So you have to allow for a margin of error because you don't know exactly what's going to happen with utilities, taxes. I mean, you do more than in Cook County and in Phoenix, on taxes, but or rents or economic
Right.
drivers.
Yeah.
So anyway, it's just not it's an art more than it is a science, right? And the scientific part of it is subject to some flex, so you have to be confident enough that you've left some buffer in your assumptions.
Right. Yeah. Yeah, that's right. And then on the whole two pro forma thing, where like the reason we were doing that is our depending like on a lot of the deals we were maybe leasing it for cheaper. We were doing it just all sort of internally. So then we were maybe coming in below what maybe the market would assume for leasing fees, but then we were higher on repairs.
Yeah.
So we just made the actual adjustments so we could go, here's how we're running the other. Or even like when I bought the Pierce deal, that's a 16 unit. I had an exact carbon copy, basically 16 unit like that, as well as an 8 unit that was real similar. So we just saw how we were running those and then said, here we go. And we had noticed on one of them, the water bill was way out of control, I think on one of the Pierce buildings. But that was obvious to see because I had essentially already buildings like that. And we go, well, we're spending $7,000 a year on the 16 unit for water. This one of the buildings for it has 8 units because these are two side by side 8 units. One of the buildings was like $7,000 for water. So we fixed the problem.
That's why a lot of people like to buy what they know.
Yeah.
Because it takes a lot of risk out of it if you know how it's going to operate. And depending on your management structure in general, it can create efficiencies too. So if you own 8 of one type of units versus 80 of 80 of them, there's efficiencies in that scale. So a lot of people end up expanding a portfolio with fairly similar properties in fairly similar submarkets, at least in Chicagoland.
Yeah.
And then you reach a point and you're like, all right, well, now let's start to think about diversity a little bit. So then you go to Phoenix and you leave your buddies in Chicago.
Yeah. Download our 100+ page passive investing guidebook today at riseinvest.com/downloads. Accredited investors can sign up for our multifamily investment opportunities by hitting the Invest Now button on our website. Now back to the show.
Anyway, kidding.
No, I know. Yeah, well, that was I was joking the other day. The only place I go is basically to the gym and to the airport and back. Like these days, it's need to buy some Chicago deals. So
that's right.
You can
you do
get out of the building here. So yeah, I think the Chicago opportunity is going to be good. Basically starting now and this winter especially, because you can basically apply the same way we've done these Phoenix deals to Chicago now, where let's say we were going to sell these buildings that I was talking about, where now on some of the units we realized we could get 3650.
Mm-hmm.
Okay, but that's only on a handful of the units. I was renewing people at 3200, 3250, renting them out for 3300 initially, going, wow, that rented fast. I'll try for 3400, and we got it. And now a buyer could go in that, and if nothing changes and we still think the rent will be 3650 or more, and go, well, next summer I should get that whole building to 3650, maybe a little more, and then that's going to be a huge jump. And then that's going to be a great deal for them if you can just walk in and raise the rents, 10% in the first year.
Yeah, the needle moves pretty quickly at a 5 cap or a compressed cap rate, Phoenix too. So yeah, I think that doesn't feel like the marketplace in general thinks that there's going to be similar growth next year, but I think some level of growth is fair to assume given the inflationary environment that we're in, and kind of just the wind at our backs right now in the rental market in general. It um, feels like we're more on the way up than the
Yeah.
way down, I guess.
But
And
but if you were gonna on a deal and you put 20% down, let's say, and you can raise the net income 10%, I mean, you make the building worth 10% more.
yep,
So now that's a 50% return on your down payment in a year. Like that's a good profit you're walking into, so that you don't even really need big rent growth the next year. You just need to know what the market rents should have been. If I was selling that deal, it would be a perfect one to go, okay, well, I already have the comp. It's these two units at 3650.
yeah, I think that you, as a buyer, some buyer advice is looking for the proof of concept, whether
Yeah.
it's in your own portfolio or whether it's in the subject property. Don't get too lost in the weeds on the chunk of the rent roll that's lower. See what they're getting on the newer leases, because that's the most real-time information about that property. Now if it's one and the rest of them are
Right.
if there's a clear outlier, then that's one thing. But if they've reliably gotten, in your example, you got 3650 the last 3 or 4 times you got it, and you got it in a week of being on the rental market, that's what the market is for those. So I would challenge people not to discount it to 3,200. And people say, well, I don't want to pay for the upside in the deal. Well, it's going to be tough to buy it then. You have to, I think, give some credit to the upside in the deal, and you hope that you leave a little bit of meat on the bone for yourself as well. But yeah, I agree. I think in the marketplace that we're in, with how dynamic and increasing the rental market is, it's going to be tough to win deals if you don't give some credit to the high water mark, either within the property or within your portfolio or the submarket in general.
Yeah, and by credit you mean just attributing extra money towards the price, knowing if I can raise the income and value 10% year one,
Yeah.
maybe I got to pay 2 or 3% more for the property to win it, but I'm still 8 to 7% ahead.
That's right.
what you mean.
That's right. Yeah. Yeah. I mean, like if it's a heavy lift, you can't expect as a seller to get full freight on the value add and it be worth today
Right.
exactly what it is, because there's risk in doing that. There's time, there's bandwidth. But to share in the upside is generally how it goes,
Yeah.
for the value add deals, especially with how much appetite there is for value add deals in general. The buyer pool forum is willing to pay for some of the upside, not all of it.
Yeah, and also too, your lender, most all lenders are looking at in-place cash flow. Not all. You can get banks to go, okay, here's my, here's my pro forma once I get all the rents to 3650, and they can give you credit, so to speak, too. That's essentially how we've done all of our Phoenix deals. Is like it's in part on the day one, but it's really on when we're done. What does it look like? And then the lender's going, I'm very comfortable with that. I know I'll get paid off, or you guys could sell at a profit and pay us off. So you'll be fine. So yeah, that makes sense.
I heard on a podcast that you're supposed to match your loan product and the prepayment with the business plan. That's
Yeah.
what I heard on
Yeah,
Resident
that
Dust
is-
podcast before, and it's great advice. I'm busting your chops a little bit on it, but it's great advice, because if your business plan is to add value, get a lender that'll give you a loan to cost loan or give you some construction dollars, or at least look at the pro forma model that you put together. If it's already buttoned up, then put a lender on it that wants the more cookie cutter, down the fairway product, and we'll give you the best rate today.
Right.
But too often people, I think, are rigid in the financing part of it because of just comfort of using particular lenders, and then they just keep going. And if it doesn't work, it's like, well, that deal doesn't work. Talk to another lender,
Right.
So
Yeah, that's a great point. And yeah, you're right. Not only match up the loan, but the lender, I guess, then
Yeah.
too. That's right. Yeah, completely. Because if these deals were stabilized, the lenders we're using on these, we'll call them not stabilized properties, where we need to renovate them or raise the rents, like you'd pick a different lender if it's stabilized.
yeah, and in today's marketplace, with where we are with rates and how kind of volatile it is, there's been some of the bigger banks and the agencies have kind of just priced themselves out of the market. So if that's your only horse that you ride, then you're out of the market.
Yeah.
But if you're open to talking to other lenders, then you can still participate for good deals, because you understand who else to go to and who's more aggressive today. So, yeah.
Have you seen the higher interest rates? So kind of, if anyone, just kind of update everyone if you don't know, but just sort of between, let's call it mid-March to, now here mid-June, like
Yeah.
rates are up, an entire percent to like, depending on the lender type, even a little over that.
Yeah.
So, rates went from being in the threes to being in the high fours, let's say for a fixed rate, and to some lenders into the fives already. Have you seen that impacting price, or how are people responding to that?
So far, the rental market is offset. So there's been enough strength and optimism about the rental market where folks are still getting to the same values. If we see another similar run up, if rates go up on par with kind of the increases that the Fed has told us are coming pretty explicitly, then at what point it becomes impactful and to what degree, I'm not sure. I think part of it will depend on what else is going on in the economy and Chicago rental market in general. But inflationary environment like we're in, it's it's a great hedge against that. Apartment buildings. So it has not been, kind of like I said earlier in the podcast, it's been more impactful on kind of if I'm going like the bookends, the highest end or the lowest end of the marketplace in Chicago. I think have felt it. But in the middle, it really hasn't translated to lower pricing at this time.
Yeah, and because the cap rates are still greater than the interest rate, so you're getting positive leverage. And because a lot of these deals, sure, if you're going to buy a low 5 cap and you see room in the rents, maybe you're going to get that to like a 6 cap.
Yeah,
you're borrowing. Usually, seems like everybody here is doing fixed rate for these kind of things. Like the people and we keep talking about our Phoenix deals, but we end up a lot of times doing floating rate just because there's no prepay.
Yeah, so then 3-ish year business plan,
or even and then if it happens quicker, you want to be able to refi or sell, and so like that's what's driving that. But here in Chicago, the deals, they don't trade as often. Like there's buildings you sell, and it's like almost like that's like offline now to the market. It's never.
Yeah, a lot of the clients that I sell to are like generational holders. So I sell a deal. Today I've got it, like I mentioned, a knock on wood, a good one closing. Otherwise, that's not going to age well. And it's in a black hole. The owner 100% is not going to sell it for the rest of my career. And so, and that's a good example. I mean, that owner that rate was locked at in like the low threes, 90 days ago, something like that. But the rate for that deal today is probably low fours, local bank debt, and that borrower and that buyer is not as sensitive,
right?
Because they want to own the asset forever. And like you alluded to, there's a scarcity it's not a commodity. There's real scarcity in that real estate. So depending on the size of the asset, depending on who the buyer pool is, it really isn't even going to matter if we have a run up. Now, I don't make my living just selling that type of product because they don't trade very often.
Yeah.
I have a good market share in them, but like if I just waited for, 50 to 100 unit deals in Lincoln Park and Lakeview to sell, I'd have a lot less to sell.
Yeah.
So that's not all of it, but that particular part of the marketplace is very insulated from increasing rates because there is a captive audience whenever you have the right type of product for them.
Yeah. And then they are, they're putting down a lot of money. And they're really strong borrowers. So then they're not, and again, they're doing fixed rate. So they know what they're getting. Their business plan isn't, I'm going to buy that and sell it in 2 years. Those people are real worried where are things going to be in 2 years. Rates could keep going up and it'll be tough. These folks are not really worried about that. They're just going, I bought things for back when they were 50 grand. Now they're worth 10 million. I'll just keep buying and it'll be this $10 million building will be worth 50 million at some point. And it'll be paid off. So I know I'm making money.
When you look at things globally or generationally, it takes a lot of the pressure on today's, challenges.
Yeah. Because that's how a couple of my investors are, and that's how they talk.
Yeah.
Like this thing's a cash cow. Why would we sell it? Or deals we bought for, $5 million, they're worth $8 million. We paid the loan down to $2 million. And I'm like, hey, let's sell it and buy something for 20. And they're like,
good idea.
Yeah, but they're like, no, why bother? Let's just, we got all this cash coming in. Let's just buy another deal with that and just sit on this other one. Why? And so that's again like another building that's like not going to come around very often.
Yeah.
So nice. What are some reasons people are like selling today then?
Like I mentioned before, a lot of it's been to trade. Looking at something where the business plan has either run its course or, like I mentioned, it's some type of outlier for them. In the space that I work, the middle market space, $2 to call it $40-ish million. A lot of it's just life decisions, somebody retiring, somebody wanting to spend more time doing something else. Unfortunate, deaths in the family and stuff like that, where you have a stepped up basis and maybe the next generation doesn't care to be in the business because it is pretty hands on. So I'd say today's reason that's most common is the trade, and then all the other reasons why people just decide to sell based on personal circumstances. But in Chicago, and the market's been strong for selling apartment buildings for a long time. So sellers have had a good marketplace to sell into for a while. So we're not really getting people that like kind of had a It's not like a whim. It's something that either something changed, or they just now's the time.
Yeah, are they talking about like, I feel like this is my window to sell? It's not really like trying to time the market.
No, and it doesn't feel like there's much urgency from sellers, but the sellers that I expect to see more of over the course of the next year or so, and then the crystal ball, who knows, but is folks who would otherwise refinance. It's been a very attractive proposition to add value and then refinance a lot or all of your capital out, and then keep the real estate and continue to cash flow it. As rates have gone up, the proposition of refinancing has gotten less attractive, and maybe real estate taxes have gone up additionally, and maybe it makes sense to sell more than to refinance. So I do expect to, I lose probably more business to refinances historically than competitors. So I lose deals to competitors too. That wasn't like a cocky statement, but more often than, hey, I hired somebody else, I hear, I'm going to keep it and refinance.
Right.
So I expect to see some more of that inventory. Also, deals with assumptions are all of a sudden more attractive, where that was like a bad word,
right?
Because everybody most people like to use their own lender and see their own loan docs and start from scratch. Now assumption deals look pretty attractive. You made some money doing assumption deals over the course of the last few years, but part of that is because people were too lazy or too didn't want to do them. They wrote them off before they dug into it. So you were able to buy deals at depressed values because there was less of a buyer pool, and maybe you had to assume a slightly above market rate. Well, now we're selling deals where rates are quite a bit lower than prevailing rates in the marketplace. So
yeah, I can see that. Another big negative on the assumptions is you're starting somewhere in their loan amortization schedule, like further along. So let's say you put a fresh loan on. The comeback would be you make the same amount at the end of the day, because you're just paying your loan down more. But if you need that for later, for you, how if you put a new loan on, oftentimes you can get 1, 2, 3 years of interest only payments, and then you start a new 30-year amortization schedule. So just all that means you just have lower payments than if you come in year 5 of someone else's amortization schedule. Now more of your loan is going towards principal than it would at the start. So you end up with a bigger payment, like all things being equal. So like that's
but it's funny because it's math, right? You just adjust it on the model.
Yeah.
and if it changes the end of the output, then it just changes the end, the price at the end of the model. But it's funny that people just write it off as opposed to doing the math.
Yeah, well, or you'd have to be just like a cash flow only buyer to write it off and be like, oh, the cash flow is lower.
Yeah.
But you're going to get that when you sell.
So but you'd be surprised at how much of the marketplace before today, how much of the marketplace has seen an assumption deal and it's a non-starter.
Yeah.
I mean, it cuts the buyer pool in half.
It seems like that, or even more. That makes a lot of sense, because I've noticed that too. Where, and I think one thing that you might be the new competitor when you sell is like, oh, I really want to get my price. Otherwise, hey, I got this loan for 3.5% interest. I might as well just sit on it. If I sell it in trade, I got to go get a 5% interest loan. I'm gonna, be paying more. That's probably what's gonna be the new competitor for the refi. Almost is hey, my rate's low. I really need to get my number.
Particularly on the trade deals that I mentioned have been so much the market.
Yeah. Because then if you're going, okay, I'm gonna be buying a property, I'm taking out a bigger loan at a worse interest rate. Like that's in their back of their mind.
Yeah, but most people that buy a middle market size apartment building in Chicago go into it with a business plan to do something. And even if something is hold it forever. So generally there's some compelling reason otherwise to do the transaction that would offset that spread between the rate you have in place and today's rate. But it's not all the time.
Yeah, makes sense. Well, great. Well, let's leave it there, Joe.
Sure.
Thanks for being on. Appreciate it.
Good to be here, man. Thanks again.
Yeah. So how can people get in touch with you if they want to reach out?
Easy to find. Look up Joe Smazal at interrarealty.com. I'm really accessible via phone or email. Love to hear from anybody listening to the show. Heard from some people that listened to our podcast last time around. So it was cool to people said, hey, I listened to a podcast or something that I liked, or I'm interested in getting in real estate. You have a minute to talk. So it was cool to hear from people afterwards.
Yeah, I had on our episode, I had a couple times I had been sent something where it was other people saying something, positive about it, where like another, I forgot where they work, but it was a broker that knew one of the guys who works here, and they sent it as like, this is going around our like office. Yeah, it's like, check out this podcast. This is good.
Well, I hope we get a similar response. So yeah, I'd love to hear from people listening to this show. And there are not that many Smazals out there, so it's not that hard to find.
Yeah, easy to find. So, or you can look at my LinkedIn or something. You'll see me liking the post.
For sure, man.
You find it that way too.
Good looking out.
So yeah, well, great. Yeah, appreciate it. Thanks again.
Man.
Great. Well, until next time, everyone. Thanks for joining us, and we'll see you on the next episode. Thanks for joining us on the Rise and Invest podcast. Please be sure to hit that subscribe button on YouTube or wherever you enjoy your podcasts. If you'd like to dive even deeper into real estate investing, check out our company's website, riseinvest.com, where we have numerous free resources and information that can help both active and passive real estate investors. Our 100-plus page passive investing guidebook, our trends report, and our blog are all available on our website. If you are an accredited investor, you can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Brenneman and guests as of the date of recording and do not purport to reflect the views or opinions of Rise Invest Holdings LLC and its subsidiaries. The views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities, and the speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.